Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. I was watching Kaun Banega Crorepati when a single question hit me like a ton of bricks. It was about Elon Musk. The answer revealed he'd become the first person in history to amass a net worth of US dollar 500 billion. 500 billion, think about that. In 1987, Bill Gates became the world's first tech billionaire. Now, less than 4 decades later, we've leaped from 1 billion to 500. That pace is unprecedented, and it's all driven by technology, specifically artificial intelligence. The AI narrative is compelling. It will reshape every industry, create untold wealth, and yes, also create perhaps the world's first trillionaire. You heard that right. There is a high chance the world's first trillionaire could come from some AI related application. But what if this logic is completely flawed? What if AI is a phenomenal technological revolution but a surprisingly poor creator of durable investor wealth? Well, this is exactly the compelling contrarian case being made by a few savvy investors, the people who actually make money when everyone else is losing it. They argue that we are falling for a seductive trap, confusing world changing technology with profitable investment. Now, the foundation of this argument is a single staggering number from McKinsey. Cumulative global spending on data centers, the physical infrastructure needed to power this AI future, is projected to hit US dollar 6.7 trillion by 2030. That's nearly $7 trillion. Now, David Einhorn, a famous investor of Greenlight Capital, looks at this number and asks a deceptively simple question: where will the nearly $7 trillion come from? It's basic financial physics. The capital expenditure, the capex required, is so extreme it pushes the limits of the world's most valuable companies. Einhorn calculates that even if giants like Apple and Microsoft completely halt all dividend payments and share buybacks, they still could not find this AI vision without taking on a dangerous amount of debt. This isn't just spending, it's an all in bet on a future that has yet to materialize. You see, the core problem is the math. Right now, in the AI ecosystem, every dollar of loss making customer revenue cascades into more than $8 of aggregate revenue across the supply chain. Let me break down this distorted economic model. Imagine you pay $1 for an AI chatbot subscription. Now, that AI company is currently losing money on your $1, but to serve you and millions of others, they must pay massive amount of money to cloud providers like Azure or AWS for computing power. And those cloud providers in turn must spend billions buying advanced chips from companies like Nvidia to build that capacity. So the AI app company books $1 in revenue, the cloud provider books several dollars in revenue from the AI company, and the chip maker books revenue from the cloud provider. See the pattern? The infrastructure and hardware layers are booming. Company like Nvidia, their historic profits are very real, but they are being built on a foundation of AI applications that are, for now, burning cash. So the prosperity at the top of the supply chain is being subsidized by investment capital and massive losses at the bottom. This dynamic, David Einhorn warns, almost guarantees a tremendous amount of capital destruction on the journey to the profitable AI future. Now, if this math is too complex, let's turn to the Oracle of Omaha, Warren Buffett, for a simple, timeless lesson. Buffett's cardinal rule is this: the key to investing is not how much an industry will change society. The key to investing is a company's sustainable competitive advantage, its moat. Think about the airline industry. Which other industry has done more for society? Airlines have shrunk the world. They have grown massively. Yet, as an investment, airlines have been notoriously terrible. Why? Because they are intensely competitive and brutally capital intensive. Airlines constantly earn profits only to have to plow them all back into new expensive planes. No lasting value for the shareholder. Now contrast that with See's Candies, a business Buffett bought in 1972. It sells boxes of chocolate, zero technological disruption, but thanks to a powerful brand and customer loyalty, its moat, it's been a phenomenal wealth compounding machine. So, the world changing nature of an industry does not automatically translate into shareholder wealth. The AI revolution could easily follow the path of the airlines, revolutionary for its users, but a brutal, capital intensive battlefield for most of the companies competing within it. This is why savvy investors are refusing to participate in the current AI frenzy. They are willing to endure short term underperformance rather than risk the permanent loss of capital in what they see as a speculative bubble. History shows us that when the tide of irrational exuberance turns, it turns fast. So, where do you stand? Is AI a transformative opportunity too big to miss, or the next great bubble waiting to burst? Well, we find ourselves aligned with the sober analysis: sustainable competitive advantage, a margin of safety in valuations, and strong business fundamentals. We'd much rather forego a speculative profit than risk our invested capital on a future that may not be as profitable as it is promising. Let me know in the comments, is the current AI boom a revolution, or is it a bubble waiting to pop? Don't forget to like and subscribe for more deep dive analysis. Happy investing.